So today we will be doing another part of the talk series. Okay, Zach's session will be on tomorrow, Friday. So for those of you who are looking for the stock review, you can join Zach tomorrow next at around 9:30 p.m. Okay, right. Hi, Dr. Derek. Hello, Nick Faris. Nice, yes, on. Okay, so we wait for a bit more until we reach number of people, then we will start. Okay, hope you all had your we call this dinner already. Okay, hi Aris. Hi. Okay, so while waiting for people, we just have a bit of start. Okay, so good evening everyone. So again, today is with me Alif, and we are talking about the one of the many mini series which is on the magic formula subject. Okay, and while waiting for people to come in, we will just have a look a bit on the futures segment here in terms of the crude oil and also on our FCPO side here. For our FCPO market, we are seeing that the market has kind of like moving within a sideways range here. Okay, but we're estimating probably the market may hit the 20 MA before it starts to move up, or maybe it will move sideways range for a couple of days before it starts to make the up move. Again, it's quite related to our crude oil here. Yesterday was up, hit above the resistance, but it's just that the market now currently is making an upthrust here, as you can see. Okay, there's a one upthrust here. Yeah, one upthrust, but this next bar here, the price is closing above the upthrust, and we have the break through the resistance with a VSI bar here, so it's quite a good indication for the price should be going up further. Okay, but till then we have until this Saturday until 5 o'clock in the morning to see whether really the price is going to be on an upward move. So we have sort of like another one more day left for the crude oil to show us its true color, or perhaps maybe by next week then only we get to know. Okay, right. So okay, we have a number of people here already, so we will start with our presentation today. Right, so if you notice, you can see me more clearly now because Martin lent me one halo light here, so you all can see my face getting brighter compared to last couple of weeks. It's a bit dim because of the lighting position in my room. Okay, so right, so we will start today, and this is one of the many of the mini series. Today will be the third mini series that I'll be talking about, which is about regarding magic formula. Previously on my first series talk, I talked about the moving averages, and a couple of weeks ago I talked on the second mini series, which is about canceling. Right, so now we will begin, and today I'll be introducing you to this one personality who is a bit different from the previous personalities that I've introduced you to. Okay, and this personality here, he is a ardent follower of Benjamin Graham. And how many of you have heard of Benjamin Graham or Ben Graham? Just type one in the comment there, and we have to see how many of you have heard of him. Okay, and of course, at the same time, for those of you who know another fellow investor who is also a student of Benjamin Graham as well, you type 2. I think this person also, everybody knows about this person. All right, so just type number 2 if you know the person who is also a student of Benjamin Graham. Okay, let's just see how many people in the will respond from there. Right. Okay. Right. So okay, no problem. So Benjamin Graham here. Okay. So he is also, yes, he's also a seafood to Warren Buffett, just like Tom Williams is the seafood to Martin. Okay, and Martin is my seafood. Right. So the personality here that I'm going to introduce you is a well-known amongst the fundamental analysts. Okay, and also in terms of among these value investing people. Okay, and he is none other than Professor Joel Greenblatt. Okay, so we call him Joel for short, right? So Professor Joel, he is a graduate from the Wharton School at University of Pennsylvania, where he wrote a paper on how the small investor can beat the market. And he does this while he's doing his MBA in the 1980s, which he graduated with the highest distinction. And his paper for that particular subject was published in the Journal of Portfolio Management. So Joel also is an adjunct professor at the Columbia University School of Business, and also an author of New York Times best-selling book, which is The Little Book That Beats the Market, which is the blue color here. Okay, of course another one is the green color, but the famous one is the blue color here. You can get it at Amazon, or buy from me to get the hard copy, or you can just download it once you have made the purchase. Okay, right. And in addition to this also, Joel also served as a director at Zena or Penna Investment Management. It is a high-end value firm where they traded with asset under management of nearly 34.9 billion US dollars. And this firm, okay, it was founded by his uni-mate and American investment manager, which is Richard Penna. And goes to show, that if you know someone of the same interest and of the same passion, it can help you in your career-wise, or in your business, okay? And in 1985, right, Joel started a hedge fund called the Gotham Capital, okay? Not this Gotham Capital like Batman here, okay, although it's got a nice chart there, alright, double top, and we have an eye there, but it's not that Gotham we're talking about. What we're talking about is this Gotham Capital, which previously was called Gotham Capital, but now it is known as Gotham Funds. Okay, and this is the fund where it generated an annualized return of 50% from 1985 to 1994 by investing in special situations such as spin-offs and other corporate restructurings. Okay, and if you see, when I mentioned about this, they invest in spin-offs and corporate restructuring, it is very similar to what Warren Buffett did when he first started into this world before he found this, or before he acquired Berkshire Hathaway. Okay, and we can see that quite similarly, Joel and Buffett, they are using what they call a cigar butt method. Okay, in those days, why they call cigar butt method is because in those days, right, when those people who smoked cigar, then they would, when the cigar was quite near to the end of the bottom here, okay, then they would just throw it away, right? So at the end of this bottom here, then they would just throw it away. So those people who wants to get a puff of it, right, they will just find that cigar butt, which is still a bit lighted there, and they will just take the last puff, okay, the last puff of the cigar, and finally they will discard it off because you can't get any more puffs from there. Okay, so this last puff of the cigar, which it means that the stock may have the one last stretch to move up higher, either through like new funds coming in, or through the corporate restructuring, like what I've said earlier. Okay, so coming back to this Gotham Capital, they run the funds privately from 1995. Okay, before that was 1985 to 1985 to 1994, where they generated around 50% returns. Okay, that was before the net of the whatever fees available. All right, and from 1995 to 2009, they run the funds privately. Okay, and then after that, 2009 to 2016, they make it 2009 onwards, they make the funds available, in which you can see from this side here, this chart here, this is the S&P, which is the orange color, and this blue colored line here is the Gotham funds. Okay, and you can see in terms of comparison that the funds outperform the S&P by around 52% based on the chart here. Okay, now you may wonder why during that 1995 to 2009 that the funds were being traded in private manner. It's because that at that time Professor Joel already mendirikan rumah tangga, and also he has already have children, so he wants to be more with the family, spend time more with the family. So he decided to return all the funds, which at that time was around nearly $500 million, okay, in 1994, such a big amount. Of course, the investors are not happy, but to Joel, he thinks that, I rather spend the best time with my family and to see my children growing up. Okay, so which means, funds doesn't mean all about, handling investment or trading is not all about money. It's also about seeing your kids growing at the same time. Okay, so you need to prioritize and see which one you should spend the most in whose person's life you need to spend the most. Okay, right. So coming back to this one. Okay, the funds that you can see here, they spend they outperform S&P by around more than 50%. Okay, and these funds are using majority of it they use is the magic formula, that is using two easy formula that focus purely on fundamental analysis. Okay, now if you look very much on like the CAN-SLIM previously, which I talked about, okay, CAN-SLIM method, what they talk about is using the both fundamental and technical analysis. Okay, and for those of you who are first time hearing about CAN-SLIM, what they do is that it's actually an acronym of 7 criteria which they look at: the quarterly earnings, the annual earnings, new development of the company, the supply and demand, leading or laggard, institutional sponsorship, and the market direction. Okay, so if you want to know more about CAN-SLIM detail, or you want to refresh a bit for those of you who have heard of it but kind of like ingat lupa, so you can just scan this QR code here, okay, at this QR code here, or you can just copy down the link below there for you to typing into your email there to search for it. Okay, alternatively, of course, you can search on the video in our Facebook page at Martin TF Form, but of course you do it after the end of my presentation lah. Okay, right, so now we will go and talk about magic formula. Okay, so what is magic formula? Right, so magic formula is actually a modified version of Benjamin Graham's simple way methodology in selecting bargain stocks. Okay, so Ben Graham's way, this is Ben Graham here, by the way. All right, so Ben Graham's simple methodology, of course, he looks at two fundamentals, okay, which are stocks should be both cheap and relatively safe. Okay, cheap stocks and safe, right? So cheap as in the earnings yield must be at least 2 times the average yield on long-term AAA corporate bonds, right? And safe means that where the stocks selected carries little to no debt, right? So these are the two things that is being observed by Benjamin Graham. So what Joel did is he modified it and using the same methodology, of course, but he just twists a bit, is that he looks at cheap companies, okay, by trailing the operating income to enterprise value, and at the same time looking at good companies by trailing operating income to capital employed in the business, right? Which means, in other words, you're looking at one, earnings yield, and number 2 is return on capital. Okay, now bear in mind that magic formula is purely fundamental, meaning to say that it does not look into technical analysis at all. Okay, unlike CAN-SLIM, where you look into both the technical, the fundamental, as well as the company itself. Okay, now apart from these differences, okay, another thing you must take note is that for magic formula is that you need to use a bit of judgmental assessment when making the stock selection. Okay, and as with any other methodology, whether fundamental or technical, judgmental analysis or assessment is also one of the important criteria when you select a stock. Okay, so how do you apply magic formula? Okay, first, of course, we talk about the earnings yield first. Okay, we tabulate the earnings yield by dividing the EBIT with enterprise value. With EBIT here means earnings before interest and tax, not the other the Islamic preacher that one EBIT Liu. We're not talking about him. That's totally different. Okay, this is talking purely about EBIT in the sense of financial or accounting purposes. All right, and EBIT here, it means is that it measures the company's profit, including all income and expenses, which is both operating and non-operating, okay, except for interest expenses and income tax expenses. Okay, so EBIT is sometimes, of course, for those of you who are accounting background, EBIT also is sometimes synonymously used with operating income or operating profit, that terminology there. Okay, but it's almost the same there, right? Another one is enterprise value, which simply means the total market cap plus debt plus preferred shares, okay, the total of that, and then you minus out the total cash and cash equivalent inside there. All right, so market cap, you can get the information from the Bursa site there, or if you log into like your U-Trade or RHP, the trading platform, you can get the information of how many number of shares available for that particular share, and then you multiply it by the latest. Okay, sorry, I saw a bit of disconnection. Okay, so for where was I? Market cap. Yeah, so that's the market cap. That's how you look into the market cap inside there. Okay, and the rest of it, which is about the EBITs, okay, and then the debts and preferred shares and so on, that's where you will look into the company's financial report, the annual financial report. Okay, we do not use the quarterly report because of the period is quite short from that. Okay, so now the easiest way to calculate earnings yield is by dividing 1 over PE. That's quite the simplest way for you to calculate. Okay, you can use this methodology to calculate, all right, inside this website here, but best way is the fastest way, not the best way, the fastest way is 1 divided over PE. Okay, now the next one would be the return on capital, right? So tabulation for return on capital is simply by dividing EBIT again with the total of net working capital plus net fixed assets, right? So what constitute the net working capital and net working assets? Net working capital is the capital or the amount of money which is required for you to spend in order to operate the company. And definitely, if you take the analogy of having a gear with oil, okay, you need some oil to make the gear functions, and the oil is the money which it needs to use to move the gear, and the gear is the business. Okay, that's in terms of the analogy. And then net fixed asset are assets that cannot be converted easily into cash. Okay, which is you have like those buildings, or you have those machineries, for example, okay, which you can't readily convert it into cash at all. This is different from stocks or inventory, okay, which you use it to can do for the business purposes. Okay, I hope I get that part right, because if not, because I don't have any much of a background on accounting, but that's sort of my understanding on that, the detailed part of that. Okay, alright, so again, all this information, okay, the net working capital and the net fixed assets, you can obtain it from the company's annual financial report. And again, we do not look on the quarterly report, the quarterly earnings report. Okay, now once you have established the figures for earnings yield and for the return on capital, okay, so the next step is to rank the stocks by according to the highest earnings yield, and then you have the highest return on capital. Okay, and from here, that's where you need to use your discretionary assessment already, because from here the highest combination of the two factor is ranked the highest in terms of the magic formula strategy. Okay, so that's where this discretionary come in, because for example, if we have a stock, for example stock A, which is the 15 highest earning yields and 25th highest return on capital, combine the two, they give a much better combination as compared to stocks with 190th highest earnings with 50th highest return on capital. Okay, so that's why you need to use a little bit of a judgment to make a selection from there. Okay, so the analogy for this comparison of the highest earnings yield and highest return on capital is, you put it this way, that earnings yield is like we put analogy of you buying a house. Okay, so let's say earnings yield is the amount that you're willing to pay for the house there. Okay, of course, the cheaper the house, the better, right? And then the return on capital is somewhat like how much can you get in terms of the return from that property per year, and we're talking about like rental. Okay, so which one do you think? Would you like to buy a condo which you just need to pay a small amount of capital, okay, but or you buy at a very lower price, but the return yield, okay, is very high for 1 year? Okay, or would you rather buy a house which is very expensive, okay, but the rental yield is low? So which one would you think you want to buy? You can leave it in the comments inside there. Okay, so definitely in terms of magic formula here, you want to have something where you buy where the value is very low, okay, but it gives you a very high returns per annum. Okay, so that's the analogy if you put for using this magic formula. Okay, and coming back to this one is a magic formula. Once this ranking has been made, okay, and then you take the top 10% of the stocks and then you select the best one from there, which means is that you basically narrow down your selections and focus on the best stocks. Then after 1 year or so, the period, you sell the company that you or the stocks that you own, and then you rerun again your magic number, and yeah, again the same process will happen again. But instead of you doing it frequently, like Slim, you do it like every time when the funds doesn't fulfill the criteria, you just take it off. Okay, same principle, but you do it on a yearly basis here. Okay. Of course, some of the assessment is that they will hold a bit longer, more than 1 year. If they find the criteria is still fulfilling, they will still hold it for longer, more than 1 year. If those are not so fulfill the criteria, then they will just, after 1 year, they will just cut it off from there. Okay. Now, the pros and cons, right? As with all other methodology, there are pros and cons inside here. Okay, is that the pros will be that you'll be good for long-term holding power, right? Which means that those who have the cash, the spare cash, but don't know what to do with it, or a fundamentalist looking for more long-term capital growth, can consider using this method. Okay, and which means that you are your own fund manager handling your SLF, which is small little funds. Okay. Number 2 is that you review the company performance annually. Okay, like I've mentioned earlier, you can basically decide which company that you want to hold longer and which company that you want to let go by just looking at the company's annual performance, annual financial report. Okay, and those with good or strong fundamental, usually you may want to keep for another year until the next financial report will come out to say that, hey, look, this is the report that I received. When I do the magic number, the magic formula, it doesn't jive with it. It doesn't meet the magic formula criteria. So then you take it out from there. Okay. And then the third one is that it is a potential to earn high returns, because as you will be able to extend or drop any of the stocks along the way, right? You will be able to get your capital to expand and to grow year after year, and eventually you'll be able to get it to beat even the inflation rates, even the EPF returns or ASB returns. Okay, but of course, if you're able to get the discretionary part right, because the con side here is that I think this two here is a bit of an error here. They are supposed to be a different one. The first one is it need time for you to do research, okay, because you need to spend time to do research on each stock to create the list. You need to go through the listing on the financial reports to get the information that you need, okay, and this will take a very a bit time consuming in terms of Malaysian context. In the US, definitely, because the founder of this magic formula is a US person, is American, so therefore he has created the magic formula calculator or something. He has created from this type, the magic formula, okay, calculator or magic formula financing. Then they will have all this thing already there, okay, because when Joel created that book, right, the blue color book, he was in the impression that what happens if people followed the formula 100%, and then at the same time they will not be able to get the right returns or the right results. So he created that one particular platform for people who follows his magic formula to have a sort of like a calculator to help them to make a better filtering of their assessment. Okay. Then number 2 is it's not suitable for short-term trader, because magic formula again is a fundamental base. It requires fundamental analysis, and therefore it's not good for traders who are looking for short-term trading, right? Of course, if you have a sizable amount of capital, then you can buy maybe around 20 or 30 magic formula stocks. You hold one whole year and you rerun the process again, but then you may miss out good opportunities along the way, which later on maybe I can show you inside one of the slides that we have the charts inside there. Okay, and then last but not least is that you need to have a good use of your discretionary judgment and financial report reading. Okay, because even if you have sorted it out according to the criteria, okay, you will still need to judge and see which one that may give you the advantage. Of course, you may use the technical analysis to time your entry and exit there, okay, but TA is purely for a short term or around 6 months kind of a trading, and this one you're talking about 1 year. So therefore, there is a possibility that you might miss out stocks that can give you a high percentage return, okay. So that's one of the cons side of it, right? Now, Next, I will show you the magic formula parameter here. Okay, now this parameter here is set by Martin. Okay, and I happen to have a book of his here, as you can see from the slide here. You can see here. Okay, this is Martin's book here, the magic number stock performance guide, and the next slide I will show you is just the top of the share that he has put inside there the what you call this, the ratings in terms of the large cap, mid cap and small cap inside there. Okay, so it's inside here. This book was published in 2013. Okay, and I think it's still being used today, right? Well, of course you want it to have a much better age for you. You use Smart Robie lah. Now everything all been transferred, you know, from Martin's research, all been transferred into Smart Robie, and then the more we train Smart Robie, the more we able to respond to you well. Okay, and hopefully we can add more value to you through Smart Robie then. Okay, but interestingly, okay, apart from Martin who created this stock performance guide using the magic formula, there is one research was done also by this student. I'm not sure he or she, but the student is from UPM in 2014-2015. So this is the book, the paper that this person, Tay Wei Ching, okay, this person did this book, this research here, application of the stock screening criteria of Joel Greenblatt in value investing, evidence from Malaysia Stock Exchange. Okay, I've read this research paper here. I'm not going to say what it is. I'll give you some homework. You go and find out from here. Okay, Kerana everything spoon feed lah, spoon feed lah. Okay, you have to do a bit of research a bit lah. Okay, but summarily I would say that it is workable. Okay, summarily I would say that it is workable in the Malaysian context, but it needs a further research from there. Okay, so you can try it out. Okay, for those who have some spare cash, got nothing to do with it, then you can just use it and make a trade from there. Okay, right. So let me go for next year. This is the slide. Okay, if I use based on Martin's book inside there, the magic formula, and this is the 1 year period if I were to hold. Okay, I take based on, because the book from Martin's side here is published in 2013. Okay, so I take from agak-agak from where the report came out in 2013, in the middle of it. That's where I take it for 1 year guide from there. Alright, so as you can see here, the first one was Harta. This is Harta Lega. Okay, from the report date came out here, I think it's somewhere in around early of May. Okay, so the report came out from here, so we purchased it from here. This report here is the fourth quarter report that came out, so means we will have like sort of like one whole day of the financial report from there. Okay, I'm assuming based on that. All right, so for those who have the accounting background, I apologize if it's a bit of mistake, but this is what I based on the assessment. So fourth quarter report come out, you should have already the whole year financial out. So based on here, if you purchase from there, all right, and you hold it for 1 year, right? So this is the amount of profit you will get, which is around 10%. Okay, if you buy and hold for that 1 whole year. But then in between, you may miss the opportunity of selling at the top here, which may generate you, I think, around 40 or 42% around there. Okay, so that is Harta. Next we have here is FIMA. FIMA here will give you a good return of around 40%, nearly 40%. Okay, which has a nice setup here also. All right, if you buy at the below here and then you sell it at the top here, okay, 1 year holding period, and you should be able to generate a good return from there after 1 year. Of course, if you go back to Harta just now, okay, in 2013, 2014, maybe not so, all right. But if let's say the annual financial report meets the criteria, all right, and then you hold it until now, I think now also you're already laughing your way to the bank already, you know, because you sudah jadi orang kaya and you buy when it's at the very cheap price here. Okay. Then before I forget, Harta is the high cap stocks. Okay, and then FIMA is the mid cap stocks, and then the next one is the low cap stocks. Low cap stocks we have here is the EcoVest here. Okay, EcoVest for 1 year period. So we have here around 2012 to 2013 2013 here, okay. It should be around 2013 actually, but never mind. We see here from the period here, we purchase from here and goes up, it's just around 3.6% around there. But imagine if you to buy at the, if you use technical analysis, you buy from here and you see the price is already up here. You know, human being wanting to make more money. If you see up here, sure you already mata rambang already, you know. You see even the batu masa atas kuali also, you feel like, wow, it looks so tempting, you know. So the same, let's say you will sell here already, you know, you will forgo your magic formula and sell like that, okay. But if you purely follow the magic formula principle, the fundamental, purely on fundamental, not putting in technical, that's where you will get like around 3.6% around there, okay. Right. So one thing about Ben Graham, okay, is that he does not fix, okay, we're talking about Benjamin Graham, he does not fixate his mind to only one view, right? So he takes the few views and seeks out the best one that at that time, right? So means at that time he look on the fundamental, he talk about research and everything, okay, and he is very flexible in his thinking and is largely misunderstood by small investors. Why I'm saying this is because that when Ben Graham created this fundamental analysis, everybody will follow and so on, you know, because Ben Graham says this, so we follow this, okay. But over time, Ben Graham will have his own perception or thinking change, okay, from time to time, and then he take a different steps after that. And quite interesting because years later, in his later years, Ben Graham says that researching stocks is a bit of a waste of time, you know. So not we are looking down on fundamental analysts, but I think the message he's trying to deliver here is that if you are able to get something where it helps you in your analysis, okay, it helps you in your analysis, that make it more faster, then maybe yes, you can still adapt to that principle here. Like how Magic Formula, they came up with the one tool where those people who doesn't have the experience or the time to make the assessment for the Magic Formula or how to use the Magic Formula principle, then they will be able to, what you call this, use it and you know, to get a better returns from there, okay. Because otherwise, if you don't have any tools for them to use, then it will be quite difficult for them, and they may end up generating more losses than making profit from there, okay. So nowadays, of course, you don't need to calculate, okay, or manually, or you need to go through the screen, everything like that. We even make it more simplified for you. You can just download Smart Robie, okay. Because from Smart Robie, if you have the fundamental there and it is 3-star and above, then you can just buy and hold for long term. Or as how I've mentioned previously, okay, in the KLSE methodology, where you know, you can just see where the stocks has the good fundamentals from there, and then you can see in terms of the technical analysis wise, the chart is quite good, has a nice setup there, and then you can just buy and sell that particular stocks, and you know that because you know the underlying, the fundamental is quite good there, and if you buy and sell also for the long term duration also, it should be no problem for that, okay. But again, different people will have different kind of approach, so find a kind of a trading that really suits your trading style. Okay. If let's say you want to be a more fundamentalist, then you can try like the Magic Formula, which somewhat works for Malaysian context, or you may want to try KLSE, but it requires you to do a lot of research on that, okay. Or you can just follow us on Facebook, you know, and maybe to change your mind a bit, to try to adapt or learn about the technical analysis, okay. So we go for the summary for the topic for today. Okay, is that number one, we talk about the trader profile, which is Professor Joel Greenblatt, okay, who is an ardent follower of Ben Graham. He's also a adjunct professor in the University of Columbia, and also a hedge fund manager and author of the two famous New York Times best-selling book. Okay, and also founder and fund manager of Gotham funds, all right, since 1985 until now. So I think that's around 35 years already. The funds has been ongoing, which is quite good. Okay, and then he also is the founder of the Magic Formula, and we talk about the two variables that Magic Formula looks into, which is the earnings yield. How you get earnings yield is just that basically 1 over PE, and you get your earnings yield there. That's the fastest way to calculate. And then you have the return on capital. Okay, and then we look through some of the parameters which set by Martin inside there. Okay, and we also see some of the research done by by one of the students there. You can go and look up into that research, and they found that the methodology works in Malaysia, but the research part would say that requires a further more research on that. Okay, and of course, last but not least, to make you a better trader, you can just use Smart Robie. Okay, so they will be much more easier for you to do the trade. Right, so today will be quite fast a bit because talking about this guy Joel and also his magic formula. Okay, so hope you all learn for something from here today. Okay, and wait, let me see here. Okay, for Charlie Chia, okay, apologize because I'm not doing the stock analysis or stock review. Stock review will be my colleague tomorrow's, will be handled by Zach tomorrow at 9:30 p.m. Okay, so you don't forget to join him tomorrow. And also tomorrow morning we have Martin on the breakfast show with Smart Robie. Okay, at 10:15 on Friday, and I'll be doing one more mini series, the fourth mini series, which we'll be talking about is the momentum trading. Okay, so momentum trading. So what is momentum trading? Then the further details I will explain to you later on. Okay, so this coming weekend also we'll be having the masterclass for August 20 intake. Okay, for those who are coming for the face-to-face masterclass, just make sure that you bring your mask, your hand sanitizer, and download the My Sejahtera apps into your mobile phone. Okay, we have registered for the QR code, so it will make it more easier for you to just come in and just scan the QR code. Alright, and for those who are attending via Zoom, we'll hope to see you all in the October 20 intake. And of course, we hope and pray that, you know, for Malaysians to really follow the SOP, and we hope to see that the number of new cases is under control. I think this today is already still double digit, but lesser than the day before. Yesterday was, I think, around 21 or 26 cases, I'm not sure, but today is around like just like belasan only. Okay, so yeah, with that, stay safe. Right, maintain physical distancing, not social distancing, maintain physical distancing, and